Also invite on Closing Bell today Harish Krishnan, the Executive Vice President and Senior Fund Manager, Equities at Kotak AMC on the show. Now, the markets, by the way, have slipped again, so we're back at that 17,200 mark. Harish, afternoon, and thanks so much for joining in. How do you feel about the markets right now? It's been very tough to call. What's your prediction?
So I guess predicting near term is anybody's guess, and we are no good at it. What we have is a view over the medium term. And over the medium term, we do acknowledge the fact that India and Indian equities from a domestic perspective is doing exceedingly well. Various indicators do point to a sustenance of growth momentum. The worries are primarily coming from the external front, given both the macro developments globally as well as the geopolitical developments that have happened over the course of the last 12 months. That also brings with it some advantages in the competitiveness of Indian companies, and that is where we think there can be some positivity that can come through over the medium term. Having said that, I think valuations are where the bigger question mark is all coming about. A lot of these good things that I've spoken about are how much of it is already captured in the price. And today, when we look at valuations across the world, almost every other global market is below its 25-year median valuation, whereas we are sitting at the top or close to the top of our 25-year range. And while a lot of it is justified given our inherent strengths, as well as the fact that we have a reasonably long runway of growth, I guess in the context of where every other country's valuations are, I think that pretty much caps a meaningful upside in the near term. And therefore, what we do advise our investors is to A, increase the horizon of investing into equities, and B, clearly have an asset allocation goal plan. So from the asset allocation point of view, we run a couple of strategies. One of them is Kotak Balance Advantage Fund, which moves its net equity from 20% to 80%. And currently we are bang in the middle at close to about 50%. So that should give you a sense as to what our broader thinking as far as the equity markets is concerned.
Okay, 50% towards equity right now, Harish.
That's right. 50% is into net equities.
Net equities, got it. By the way, the market's taking a leg lower once again. We are up just 160 points. I mean, the sharpness of some of these moves is quite... Nigel was just earlier pointing out how the market was up about 220, 230. It's given up 60 points just like that in the last couple of minutes or so of trade, last 7, 8 minutes of trade. And we are at 17,172, which I think is at the day's lowest point. So just under 1% left now. You know, Max was something we were pointing out. We put out, we did a discussion on insurance earlier this morning. Let's just pull up that valuation graphic. This is it. You look at that. Max, it does, has been, LIC, of course, is the cheapest, but the largest and the cheapest. It's got its own problems. But amongst the earlier, older listed players, Max Life, by far the cheapest. Mind you, earnings in this particular quarter in terms of annualized premium growth or value of new business, margins, VNB margins will be tepid, but how much of it is already in the price is something you want to. And that is the reason why many like Max. It offers some valuation comfort, but of course growth has also been lagging and that shows up. Harish, any thoughts? Insurance, I don't know if you saw this news on Max, it was down 10%, it's recovered sharply. Any thoughts at all?
So we are positive on the overall insurance space, both on the life and general insurance. I think the runway for growth continues to remain quite long. The penetration levels, etc., are well flagged. More than anything else, I think from at least what we've seen in terms of financial services, the top 4-5 companies in various financial services have tended to increase their market share and competitive positioning quite significantly, with a tail of players actually vacating and exiting. And therefore, there is a consolidation happening within the sector. Over the medium term, this typically tends to lead to better pricing power. So yes, you're right that over the course of the last year and a half, the valuations have cooled off. Almost all of them have underperformed the broader markets, given the fact that they had performed so well in the prior period, especially pre-COVID. And I guess given the current bout of underperformance, we would think that this therefore is an attractive zone for us to back many of these life insurance and general insurance players.
Okay. Hi, Harish. Been a while since we chatted. Good to speak to you. Well, Harish, I wanted to ask you about the technology space. I think you're reasonably underweight even out there. There are obviously a couple of global factors at play, and things are looking a little iffy. So I get that rationale. But what if the stocks correct, say, they've already underperformed, some of those tech-related names, say they correct another 10 to around 15%. Would that get you interested then?
Yes, Nigel. So I think to put it in context, you're right, we are underweight. We were significantly more underweight as we started this year, and we have actually reduced some of our underweight into the space. There are two major worries that people flag out when they come to discuss on the IT services space. The first is clearly that globally there is a recession, and therefore revenues of the clients will be under pressure, and that may flow through in terms of the revenue lines and the revenue growth of the Indian IT services, which is a cyclical factor clearly. Obviously, we still have to see the recession or the slowdown, which may happen over the course of the next 12, 15 months. The second worry that people had was that margins were already lower compared to pre-COVID, despite a whole bunch of benefits of, say, travel costs being significantly lower, etc. And therefore, our margins structurally headed down. I think where we are as far as both of these worry points are concerned, I think on the margins, we are a lot more comfortable with the way the Indian IT services operates. Yes, they have hired a lot of people. So we did this analysis that roughly if revenues of the Indian IT services has gone up close to about 20% from, or 25% from CY22 over CY19 on an aggregate, offshoring mix has meant that actual revenues, because offshoring tends to deflate revenues, the actual revenues would have gone up by about 30% on a like-to-like basis. Compared to that, obviously hiring has gone up by close to about 40 to 50%. So they are definitely hired up significantly in anticipation of faster growth. And so if the growth were to slow down, there is going to be some issue as far as margins are concerned. But these are things that the Indian IT services companies can very quickly correct. And we have already seen some evidence in this quarter prints as to how margins have started bottoming out and surprising investors. So on the margin front, we are less worried. On the revenue front, clearly, we still have to see how deep the recession is. Currently, our base case is it's going to be a shallow recession as far as US is concerned. But, the jury is still out. And as and when that risk gets played out, which, as you said, could be under 10, 15% valuations being more comfortable, I guess some of the underweight that we still are sitting on can potentially get covered.
So you're more worried about the future demand rather than, on the margins contracting from here on. At least this quarter, 3 out of the 4 large IT companies showed a margin improvement, which was far ahead of street expectations. So there was significant margin expansion that we saw. Harish, thank you very much for joining in. That's the view coming in from Harish Krishnan. He's positive on the domestic demand, but he is worried about the external vulnerabilities, the uncertainty which is rising, and India's relative valuation is at a premium, and that could cap our upside. But let's get you some more opinion as we get into this break. Kenneth Andrade also remains bullish on commodities, especially on the agri space. Here out his views.
One of the very few times